calls mainly on the planes. Hello, hello, hello. Oh yeah, how's your mom? Hey, we got a Fed meeting coming up. It's Wednesday, right? Honestly, I don't know. I think it is. Need to watch more TV. At least I'd know what day it is. Should probably triple check. Yeah, Wednesday. Hey, yeah, so we got a Fed meeting coming up. The Federal Reserve Bank of the United States of America is going to raise interest rates. So I figure we could hang together and trade together. So here is a proposed agenda. I want to do a PowerPoint presentation on the Fed, the Federal Reserve Open Market Committee, the Board of Governors, the banking system. We can cover monetary policy and money supply. And then what? Then the news will come out. We'll trade the volatility, press conference. Pretty awesome, huh? So let's go. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never, ever, 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 ever risk money you cannot afford to lose. So how you doing, yo? Oh. Man, I need a haircut, huh? How you doing? Yeah, can't hear much. Get out of here. I have not touched anything. Volume, mic volume, audio device volume near max, desktop audio volume near max. I haven't touched anything since this morning or yesterday or the day before. Yeah. Okay, good. Then maybe the other guys should try turning up their microphone. So anyways, hey, my name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way. I'm also the founder of FXBootcamp.com. And I'm a human being, so I'm trying to eat lunch. Cool, huh? So, without further ado, please visit tradersway.com and open up a trading account. Then, you'll notice in the description below the video, you can download my chart templates for free. Awesome. So, let us be going now. So, I can't make this full screen because my screen is twice as much as you see. So how about that? Looks pretty good. So we got to move fast. In fact, I'm going to inhale 300 milligrams of caffeine. Boom. A Sky Killer, I'm not your financial advisor. I'm not going to advise you at all on your short trade. Oh, that's good. Okay, so I got to get you through like a semester of economics in about 30 minutes, okay? So, yeah, no, hey, don't be sorry. I'm not going to give you that advice. It's not my job. Okay, your job is to be a trader. Right, good. Cool. So anyways, in about 30 minutes, I'm going to try to teach you everything you need to know about the Fed and monetary policy, why it's important, and then what actually happens during the two-day Fed meeting, okay? So I'll take you through an agenda of what actually happens behind the closed doors at the Board of Governors offices in Washington, D.C. It's approximately just across the street from the Vietnam Memorial, and you could see the Lincoln Memorial from the front of the Board of Governor building. And the interesting thing is you go to D.C. and you can't get anywhere because of the amount of tourists. You can't go see any of the museums. You can't go see any of the monuments. It's just packed with tourists. Nobody goes to see the Fed building, yet it's probably more important than the White House. So anyways, very interesting. So who is the Fed? What is the FOMC? And what exactly do they do? A trader's guide to the Fed. Okay, first of all, they have a dual mandate. They need to keep inflation in check, and they need to keep the economy moving forward. So you want the economy to grow, but you don't want it to grow too fast. That's what it's all about. So they have to be in charge of the health of the economy, and they have to keep inflation low. Right now, the issue is it's too low, which is a very strange problem. But 20 or 30 years ago, we had way too much inflation, and that was bad. We know it's really, really bad. Problem is, de-inflation, like they have in Japan, is even more difficult to deal with because you can't force someone to invest. And if they don't want to invest because there's no good opportunity, then how do you get out of that? So anyways, let's take a look at the next part. How do they accomplish this mandate, this mission, if you will? What is their operational direction statement, or what is their tools? Okay, they can adjust the reserve requirement ratio. Okay, this is called RR. Now they can actually, the Board of Governors says, we adjust the reserve requirement ratio. They can actually do this because they regulate the banking system. And they can say, okay, banking system, you have to keep 12% of all your deposits at the Federal Reserve. Because what does a bank actually want to do with the deposits from its clients? You go to a bank, you deposit your paycheck. What do they do with it? Well, what do they want to do with it? They want to loan it out. So if somebody gave you free money to invest with, you probably want to invest all of it, right? So the Fed says, whoa, 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 whoa. You can't invest all of it. You have to keep some of it with us at the Federal Reserve Bank. You actually have to put it in the Fed. So the Fed, you can consider is a bank for banks. And the Fed comes in and says, okay, Bank of America, Wells Fargo, and everyone else, JP Morgan, you must keep a certain percentage in our vaults. And right now that's 10% in the United States of America. Okay? Now, a banking manager doesn't have any choice. They have to do that. But they can make a management decision on how much extra cash do they want to keep around. Just because they can lend out 90% of their cash reserves, well, what if someone comes in and asks for a deposit? You have to, it's on demand, you have to give them their cash. So you got to keep something left over, more than the required reserves, because let's consider that a minimum. So a manager can come in and say, well, I think our bank should keep 20%. But another manager at a different bank could say, well, I think we should keep 15. And another manager at a different bank might say 12. And another manager at another bank might say 25. It's a management decision, okay? Now, the Fed can influence this through different ways. One of the ways is through the discount window. You've probably heard about the discount window, okay? They can also, and this has been only very recently, just in the last few years, the Fed has influenced this with providing or not providing interest on those deposits, right? So there was a time when if a bank manager decided to put 15% of their deposits at the Fed, they didn't earn any interest on it. So they weren't really, there was no real incentive to keep extra money at the Fed, okay? However, now the Fed does provide interest. They provide interest just like a bank would provide their customer an interest. So there is some incentive now. Now the incentive is less than it used to be because someone could make higher interest doing something else, right? They can lend the money out to a mortgage, or they could just buy a treasury with the money. But there was a time when that was an amazing thing, that you'd get paid money to have money parked at the Fed. It was basically free money at a time when you couldn't buy anything. So that was a big thing. That's how they influenced these excess reserves. Traditionally, what they would say is you can borrow money from the Fed at the discount window, but you're going to have to pay a little higher rate, and you're going to get a free audit. So everyone tried to avoid that, but it was a way to influence, not directly but indirectly, how much extra reserves would be required. So, for example, if you needed to go to the Fed to borrow money, they would charge, let's say, 100 basis points more than the Fed funds futures rate. And you wouldn't want to do that, and you certainly don't want to get audited by the Fed. So you would keep, if your reserves were getting low and you're like, man, what if we had to go to the Fed to borrow money? No, you don't want to do that, so you'd keep some extra money hanging around. Okay, this is somewhat related or similar to the repo rate, the repo stuff that's going on just in the last 48 hours that I talked about earlier today. And then the biggie, the doozy, the best one is open market operations. Okay, open market operations is the Fed goes into the market, they buy bonds, they sell bonds, and they get exactly what they want. It's very, very, very precise. If the Fed came in and said, we're going to change the reserve requirement ratio from 10% to 12%, the stock market would fall instantly. But how far would it fall? How quickly would it fall? How would this impact the economy? No one really knows. It would definitely slow the economy down, but there's no definite way to know, like by 0.5% of GDP or by all of GDP. I mean, you really wouldn't know. Now, open market operations, if the Fed wanted to move the rate from 1.8 to 1.72, they could do it through OMOs. This is very precise. Okay, so taking a look at the chart here, money supply is the vertical line. Okay, and then how does this impact interest rates, or how does interest rates impact money supply? Well, typically you're used to a supply and demand curve, right? You're used to seeing something that looks like this and like this. Well, the vertical, the reason the money supply is vertical is regardless of what the interest rate is, whether it's 2%, 3%, or 4%, the supply of money is the supply of money. It doesn't impact the supply of money. Now, the Fed can adjust the supply of money, but the interest rate is the interest rate is the interest rate. And right? The interest rates are this way. The supply of money is if there's 1 trillion in cash, there's 1 trillion in cash. That's it. No matter what the interest rate is, there's still only so much cash. Okay, so the Fed can come in and change the money supply, and that will impact interest rates. And my goal now is to show you the relationship between money supply and the interest rate. Okay, so check this out. If the Fed can come into the market through OMOs, open market operations, right? Fed buys bonds. This is an open market operation. They go into the bond market just like you go in the bond market, like your bank goes into the bond market, like your insurance company goes into the bond market, like the Harvard endowment. Everyone goes into the same market. That's literally, they go into the open market and they buy and sell bonds. In this case, they buy bonds. So the Fed creates some money and they give it to a bond dealer. Okay? The bond dealer gives the Fed money, the bond, and the bond dealer gets the money. And of course, then the bond dealer sticks it in their bank account. Boom! Now it's in the market, right? Now it's in supply. And as you can see here, the supply of money has gone up. Okay? So the Fed just creates some money and then buys some bonds. So they remove the bonds from the market and they insert cash into the market. Okay? You see what I mean? That's how an open market operation works. Or they can sell bonds. Okay? They could come in and say, who wants our bonds? You've probably heard that they've been reducing their balance sheet. What that means is they take a bond on their balance sheet as an asset and they go into the open market, they sell the asset. What happens in that situation? Okay? Well, first of all, the market gets the bond and the cash is removed from the market and money supply goes lower. So just imagine 1, 2, 3, 4, 5. This is actually called the quantity of money. So when it shifts to the left, in this case it goes from about 4 to just below 3. Okay? The quantity of money is diminished. Okay? The market gets the bond back but loses the cash. Okay? So these are examples of open market operations. Okay? Now check this out. Oops. Okay? There's an equilibrium. The market can demand money. So imagine a market that's functioning well and you like to buy lots of stuff. Okay? Well, if you buy lots of stuff and your neighbor buys a lot of stuff and and your neighbor's neighbor and your neighbor's neighbor, they're all buying stuff. And your gardener's buying stuff and your maid is buying stuff. Everyone's got a job and everything's good. You need a lot of cash in the market. There's a demand for money. Okay? So the demand can shift with business cycles and stuff. But what I'm trying to get to is you still have a supply curve. It just happens to be vertical. And you have a demand curve, the demand for money. So like I said before, what you're probably used to is a demand curve and a supply curve. The only difference here is the supply of money is the supply of money, the amount of money. If you reduce it, it'll shift left, but there'll be a vertical line of that is exactly how much money. Or if you add money to the market, it'll still be a vertical line. It'll shift to the right, but the supply of money is the supply of money. Okay, so it's a little different from your traditional, but the equilibrium is still what's most important. Okay, the equilibrium between the supply of the money, the supply of money, and the demand for money sets the interest rate. Okay, quantity and I should be a little I, but anyways. Okay, so that is the relationship. So let's take a look at how an open market operation impacts the interest rate through changing the supply of money. Okay, the Fed sells a bond. So the Fed goes into the market, says, all right, market, who wants to buy this bond? Someone buys the bond. They always buy the bond. Okay, the market buys the bond from the Fed. Okay, the Fed sells the bond, and the Fed gets cash. Money supply shifts now, right? Because they lose cash, so there's less cash in the open market now. And check out what happened. The equilibrium point goes from one to the other, so there's less cash and the interest rate rose. So if the Fed says they want to raise interest rates, they sell bonds through open market operations. If the Fed conversely wants to lower interest rates, what do? Well, the opposite would be true. So if the Fed buys a bond, okay, the bond leaves the market, cash comes into the market, money supply goes up to MS3, new equilibrium point, and the interest rate goes to I3. Okay, so in this case, the interest rate fell from this equilibrium to this new equilibrium. Okay, so the Fed buys bonds, increases money supply, and lowers the interest rate. That's the mechanics of how it works. Here's the math, because this is really important. The Fed comes in. Okay, by the way, I'm about to tell you why rich countries are rich and poor countries are poor. What? What did he just say? Yeah, I'm about to explain why rich countries get rich and why poor countries get poor. It's because of this slide. Okay? The Fed decides they want to buy $10 billion in bonds. The formula for this, total deposits in the banking system, that's the quantity of money, equal 1 over R plus E. R, required reserves. E is excess reserves. Add them together, and you get total reserves. Remember back in that mandate? I was telling you about that there's a required level, which is 10%, an excess level, whatever each individual bank decides to keep at the Fed. Okay, there's required reserves and excess reserves. Excess being anything above and beyond the required reserves. Okay, so the total deposits will equal 1 over R plus E times the initial deposit. In this case, 10 billion. Okay, now check this out. This is really interesting. So you bust out through the math, you crunch through the math, 1 over, okay, I say there's no excess reserves because a bank really doesn't want that. So we just 1 over 0.1, which is 10, times the initial deposit of the 10B. What happens is the Fed buys 10 billion, but money supply goes up by 100 billion. So let me explain why. The Fed buys some bonds. The Fed removes the bonds from the bond market. The bond dealer gets cash. The cash is put into the bond dealer's bank account. The bond dealer's bank puts 10% at the Fed, and the rest is loaned out. Someone takes a loan from the bank, spends the loan. That money gets put in someone's bank. 10% gets parked at the Fed. The other 90% gets lent out. Someone spends out that loan. That spending gets put into a bank account. 10% gets put at the Fed. 90% gets loaned out. So on, so forth. And each time it gets smaller and smaller, 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 but the total is bigger. So what happens is the Fed actually increases money supply by 100 billion. And it only costs them 10. Now, why do rich countries get rich and poor countries stay poor? Because poor countries don't have a banking system generally. Or it's so small, it's whatever. But the fractional reserve banking system is what creates money. People think it's the Fed and the printing presses. Well, first of all, the Fed doesn't have printing presses. The Treasury has printing presses. Okay? Now, in this case, it's this idea of deposit, loan, deposit, loan, deposit, loan, and that is creating money. It's actually growing. It started with one deposit, okay, and then 90% gets loaned out. Another deposit, 90% gets loaned out. Deposit 90, and it goes on and on and on and on and on, creating money. Okay? And therefore, now you got economic activity, you got savings, you got investing, you got spending, and the economy grows because now there's more money to go around. More, think of it as food multiplying. Okay? One seed grows an apple tree with tens of thousands of seeds. Okay? Okay, I'm not going to have the time to get through this. Sorry, guys. So let's move there. And let me pull up Trade the News. Hang on. So anyways, you got some money supply going. Sorry I didn't get through the whole thing. I didn't even get halfway through. All right. Yeah, Adam's seen it 10 times. Yeah, guys. Hey, a thumbs up would be fantastic if you could take a moment to do that. We're just a few minutes away now, just from the actual announcement. If you want, I can continue with the PowerPoint presentation and go through what happens during the 2 days.
1 minute to the Federal Reserve announcement.
The 2-day meeting.
I can actually cut of 25 basis points.
I can actually take you through the agenda of what happens, who says what in what order, and that kind of stuff. But let's get through the actual release. Here we go. Be careful, guys. High volatility.
15 seconds to the FOMC statement. Fed cuts main rate 25 basis points to 1.75 to 2%. Again, Fed cuts main rate to 175 to 2 basis points. The vote was 73. The dissenters now, one more dissenter there on the Fed.
That's interesting.
Maintaining their 2019 PC inflation forecast of 1.5% and raising their 2019 GDP growth forecast to 2.2% from 2.1%.
Oh, that's interesting. Inflation the same, but growth is up.
Cutting their IOER 30 basis points as expected.
Cutting the interest rate on deposits.
3 dissenters now. Bullard joining the dissenters.
Did you hear the IOER? Interest on excess reserves.
Now, no further rate cuts in 2019, but they still see 7 of 17 policymakers saw one more rate cut as appropriate.
Okay, we talked about the excess reserves.
A gold price moving slightly lower following the FOMC statement. Futures are a little changed, and the U.S. 10-year yield at 1.749%.
Yeah, that's one more, Chucky. So now
indicating that they will act as appropriate and as expected. The Fed cutting 25 basis points.
So now you know what IOER is. I explained it before. Interest on excess reserves. Right? Which is TR minus RR equals ER. So they raised growth, but they kept inflation the same. That's a little strange. So I guess what are they trying to say? Price in a trade war?
The Fed saying they will continue to reinvest principal payments from its portfolio holdings.
So that's a little strange. All right, let's take a look around the world. Nothing too surprising here. What do I want to do? Let's go to here.
The dollar index now seeing a little bit of volatility, pushing back to up about 0.25% on the day at 98.45. Stock futures are lower once again, down about 0.5%.
South Africa didn't like it, but Turkey did. Very interesting. Any questions, guys? Feel free to ask. You're the boss. I'm just a humble currency trader. Not sure, Chucky. Doesn't really matter who. It just matters that there's less and less. Okay. Yeah, get ready for the Trump tweet.
It's worth noting that no Fed officials forecast the Fed funds rate below 1.65% through 2022.
Whoa, that's interesting. So what did they just tell us? They're not going to cut anymore? Or is that just dot plots? They just haven't updated the dot plots. I don't know how they'd make a decision to stop. Seems like they just keep going all the way to zero again. WTI is US oil. You're just on a different broker that, I don't know, labels it funny. Shame for shame. Okay, anyways, we're holding on the support, which is fine. And we're at tomorrow's buy zone, which is interesting. So I'd like to see it turn. Okay, let's just move. Gold looked fine. Like, there's no real major reaction here to anything. Everything looks fine. Quiet.
Just a note here for the breakdown in dissenters, the additional dissenter Bullard was because he wanted a 50 basis point cut, and he had made that opinion known heading into the meeting.
There you go.
That was the third dissenter this go around.
There you go. What order did I? No, I was moving my stop. No, I'm not going to scalp this. First of all, it's all priced in. We all knew what was going to happen. Where would there be any arbitrage? There just wouldn't be. We didn't even get volatility.
A reminder, we're 25 minutes now to the Powell press conference. Likely be asked about his mid-cycle adjustment statement on the last go-around, as well as the recent rise in repo rates.
I don't consider BTC either.
Just note the first time we've seen 3 dissenters at an FOMC meeting going back to September of 2016.
So think of it this way. If you bought Bitcoin and it dropped $1,000, that doesn't sound like a safe haven to me, right? And what is Bitcoin backed up by? Nothing. So you can look at the US dollar, you could say, oh, the US dollar is worthless, but it has a government that has taxation behind it. There's also a stable bond market. There's also a stable legal system. There's also a large economic base. All of that is value. So there's something. You might not like the US dollar. You might not like the money supply. You might not like the global monetary system, and that's what you look towards BTC for. But a lot of people confuse things, like they see a weak dollar as a sign of weakness in the economy. It's the exact opposite. A weak dollar for the United States shows you that we're buying lots and lots and lots of stuff from foreigners. And why would we do that? Because if we made it ourselves, it would be too expensive. What that means is, relatively speaking, Americans are filthy, stinking rich when the US dollar is weak. Now, this is peculiar because you probably haven't been taught this, but the reason it's different for the US dollar versus every other currency in the world is it has to do with the US dollar being a reserve currency. And part of being a reserve currency is you get to price debt in your own currency. And so a weak dollar means you're actually reducing your debt, right? And so, because you're now paying it back with cheaper money. It seems counterintuitive. If you see a strong dollar, things are bad. Okay? Things are bad. When you see a weak dollar, things are good. Now, I'll give you an example of that. Emerging market and exotic currencies like lira or rand, for example, their debts are in dollars and euros, really. And when those currencies appreciate, so if the euro appreciates or if the US dollar appreciates, those debts that those countries have taken on, the third world countries, when they borrow euros and borrow dollars, but then the value of the euro goes up or the value of the dollar goes up, it's almost like the third world country borrowed more money. They owe more dollars and euros in terms of their local currency. So now they need more rand per dollar or more lira per euro to pay off those debts. So in terms of their own currency, it's like they've borrowed more but got nothing for it. Okay? Yeah, sure, I'm going crazy. I just look at it as just another asset class. So I have nothing. I have nothing against Bitcoin. Okay, nothing against it. It's just another asset class. If you want to trade it, trade it. Fantastic. Okay, so I'm looking at positions. I'm looking at old trade plans. Nothing's really changed, which is really good. So now we have to be worried about the press conference coming up at the bottom of that hour. So would you guys like me to continue with the PowerPoint presentation and give you an overview of what the 2-day Fed meeting is like, what the agenda is like, who does what in what order, that kind of stuff? Mark, like I just said, Trump wants a weak dollar because that's a good thing. It's a good thing for a lot of people. Okay. Okay, continue. Let me find the thingamabobber. You are now to lose. Boom! Boom! Okay. So here it is. The Fed buys 10 billion in bonds. Money supply goes up 100 billion. MS moves to the right to MS2. Equilibrium point moves from E1 to E2, right? Which means the interest rate fell. Fed buys bonds, money supply goes up, equilibrium interest rate falls. Okay, interesting, right? All right, the Federal Reserve Bank of the United States. Yeah, here we go. You ready? 3, 2, 1. All right, so since the beginning of time, Americans have had a distrust of central power, not just of central bank, central power. Think of it. People left England because they were anti-king. They came to the United States, ta-da, they started colonies. But then the king took over again. Damn you, king! Right? So Americans really hated this power. And then, of course, kings always rape and pillage their own people, right? So what happened was, you know, if you remember like the Boston Tea Party and stuff, the British raised taxes on tea and, you know, we had the Boston Tea Party and stuff. There's always been this anti-king attitude with America and any central power. Now, a central bank, like the Bank of England, for example, is definitely one of these centralized powers, okay? So Americans have never wanted a central bank. Now, the Fed, I think, is the third example of central bank. The first two failed miserably. The first one just wasn't structured right, but this went all the way back to the founding fathers. Was it Jackson? I think. Was it Andrew Jackson that did the first one? Anyways, it failed. And then the second one was a half-hearted, half-attempted political mess, and it never had a chance of surviving. So that one died. But eventually, right, we got our central bank. But just think of it that way. Americans don't like that centralized power. So going through the political process, they had to find a solution to that, okay? Now, the catalyst to this, to needing a central bank, is always when the economy collapses and there's run on banks. A run on a bank means this, okay? Imagine you deposited money at a bank and let's say you're the only customer at the bank. And 10% of your money gets parked at the Fed, 90% gets loaned out to businesses and people. And then you show up one day, you're like, yeah, I'd like 50% of my money. I'd like to withdraw it. I want to spend it. And they're like, 50% of your money? You're like, yeah, I'd like half my money back, please. And they're like, dude, we don't have that kind of cash laying around. We have 10% at the Fed, but we loaned all your cash out, bro. Okay? And so what happens is you freak out. And you're like, well, then give me all my money, and the bank goes out of business, right? Well, that's called a run on a bank. If now imagine where someone thinks their bank might be in trouble of going insolvent, you get there first, you're like, give me my money, give me all my money. And other people then see what you're doing, and they go in and they get in line. They're like, give me my money, give me my money. And all of a sudden, everyone wants their money, and the bank very quickly just runs out of cash, and the bank fails. Okay, I don't know if this link still works. We should give it a try. Hopefully this doesn't bring up porn. Oh, advertising. Look at this. You can't even skip anymore. La 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 la. La 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 la. Can't even skip. All right. Well, I guess they paid for it and we're using it. All right.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run. Just remember that this thing isn't as black as it appeared. I have some news for you, folks. I just talked to old man Potter, and he's guaranteed cash payments to the bank. The bank's going to reopen next week.
But, George, I got my money here. Did he guarantee this place?
Well, no, Charlie, I didn't even ask him. We don't need Potter over here.
I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
I got $242 in here, and $242 isn't going to break anybody.
Okay, Tom. All right. Here you are. You sign this. You get your money in 60 days.
60 days?
Well, now, that's what you agreed to when you bought your shares.
Tom, did you get your money?
No.
Well, I did. Old man Potter will pay 50 cents on the dollar for every share you've got.
50 cents?
Yes, cash.
Well, what do you say?
Oh, Tom, you have to stick to your original agreement. Now, give us 60 days on this.
Okay, Randall.
Are you going to Potter's?
Better to get half than nothing.
Randall, wait a minute. Wait. Now, listen to me. I beg of you not to do this thing. If Potter gets a hold of this building and alone, there'll never be another decent house built in this town. He's already got charge of the bank, he's got the bus line, he's got the department stores, and now he's after us. Why? Well, it's very simple, because we're cutting in on his business, that's why. Because he wants to keep you living in his slums and paying the kind of rent he decides. Joe, you had one of those Potter houses, didn't you? Well, have you forgotten? Have you forgotten what he charged you for that broken-down shack? Here, Ed, you remember last year when things weren't going so well and you couldn't make your payments? Well, you didn't lose your house, did you? You think Potter would have let you keep it? Can't you understand what's happening here? Don't you see what's happening? Potter isn't selling, Potter's buying. And why? Because we're panicky and he's not. That's why. He's picking up some bargain. Now, we can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
But my husband hasn't worked in over a year, and I need money.
How am I going to live until the bank opens?
I got doctor bills to pay. I need cash.
I can't keep mortgage on faith. I've got to have...
How much do you need?
Hey! I got $2,000.
All right. So there's a run on a bank. All that's saying is the bank doesn't have cash in the vault. It has some at the Fed. It's called It's a Wonderful Life right there. It's a Wonderful Life. Okay? The bank has 10% in the vaults at the Fed. They have a little bit of cash, excess reserves, hanging around. But generally speaking, close to 90% of all the deposits at the bank are actually loaned out in the form of mortgages and business loans. Okay? Well, at times like this, and this is an example of the Great Depression, people were freaking out and they were running on the bank, and the bank doesn't have cash, but they're like, give me my cash on demand. Give me my cash now. and the bank fails because they don't have the cash. So they own a portfolio of loans, but you see what I mean? So anyways, what happened was without a lender of last resort, these banks started to fail. Guess who was the lender of last resort when there was no central bank? J.P. Morgan. Yeah, the guy in the white suit. J.P. Morgan. J.P. Morgan actually bailed out the United States government at one point. Bailed out the federal government. This happened more than once. Where banks failed, he showed up. Bailed everybody out. He bailed out the entire U.S. economy. Think about how rich he was. All right. He felt like this was an undue burden. He got sick of bailing out the entire country on multiple occasions. So he said, that's it. We must have a central bank. Because he was a banker. His daddy was a banker. Okay? So anyways, they got together in a place called Jekyll Island, Georgia. I've actually been to Jekyll Island. I've been into the hotel. I've been in the room that this picture was taken in. And I kid you not, I was so excited. This was right after I had moved to Georgia. So it was a true story. I bought myself a Mercedes AMG 55 Cabriolet. And it was great because the economy was like negative. It was so terrible. There was no cash. So I bought a $100,000 car for $27,000 in cash. And told my wife, get in the car, we're going to Jekyll Island. So we jumped in the car, and we go to Jekyll Island. I'm like, woohoo! The economy's crashing. It's great. It's such a good, when you're a currency trader and you see all this stuff happening, it's so fantastic. So the economy collapsed, and I was so happy, right? So anyways, we go to Jekyll Island. Yeah, this is awesome, right? Pulled up to the front, walked in, and I had rented the penthouse. Well, why wouldn't you, right? And I'm like, I want to go to Jekyll Island because this was actually where the Fed was created. So I go to the front door, and I go to check in, and they're like, we're sorry, sir, but your room's not available. I'm like, what? Don't you know who I am? My name is Wayne McDonald. How dare you, right? And they're like, shh. I kid you not, this is a true story. He leans forward, and he looks left, and he looks right, and the manager says, there's a secret meeting of the Fed going on here. And then he looks around. And Ben Bernanke's still in your room. And I'm like, what? And he's like, hey, if you don't mind, you can go to the bar and I'll buy you and your wife a cocktail. Go try the mint julep. It's on the house. And I said, I appreciate that, but would you also give me a tour of the Federal Reserve room? Absolutely, sir. Anything for you. So I got to go to check out the Federal Reserve room, this actual room that they're in, sucking on a mint julep with my beautiful wife, brand new Mercedes convertible out front, and Ben Bernanke's up in the penthouse in my room. I'm like, this is awesome, right? I was so happy, so happy. So anyways, true story, there's a spiral staircase in the penthouse, and it goes up to a room, and it kind of looks like a lighthouse kind of thing. It probably was a lighthouse at one point. Anyways, so I went up there on the roof of this old hotel, smoked a cigar with the ghost of J.P. Morgan, with lightning over the swamps way out in the distance. Fantastic day. Fantastic day. But anyways, J.P. Morgan goes to this place called Jekyll Island, Georgia, because that's actually where they would go hunting and smoking cigars and whiskey and stuff like that. So in 1907, he gets all his buddies together, and they decide that they need to start building this central bank. The first telephone line from New York City, long distance, was to Jekyll Island, Georgia. Isn't that funny? No kidding. That's how important this was. And it was secretive, so they could get together, and along the way, they could pick up their Washington, D.C. buddies, because it's halfway to Jekyll Island. And they got there, and they put together the basis for creating the central bank. Okay? So here it is. That's them creating the Fed. Isn't that sweet? Okay? But remember, they had to get this passed. And remember, I said that they do not trust central power. So they had to come up with different, right? Was that right, Eric B? Yeah, we're all waiting for Trump. Yeah, is he going to tweet or not? So anyways, the central banking system is actually a system. It's not just a bank, okay? The reason for it is Americans didn't trust a central power. They didn't want to give it to the bankers in New York City. Nobody trusts the bankers. And they certainly didn't want to give it to Washington, D.C. and the politicians. Nobody trusts the politicians, right? Right? And you see this? Kansas City, Missouri, St. Louis, Missouri. Look at these two. There's two central banks in there, actually. Yeah. Anyways, there's two central banks right here because of the farmers. Okay? Farmers. San Francisco's way out here, Minneapolis, Chicago, all this kind of stuff. So this is, in the United States, there's actually a system of multiple central banks. What is it, 12? 12 central banks. There are 12 central banks in the United States, all overseen by the Board of Governors. So each region has its own central bank. However, 50% or all of the money is still in New York, Chicago. Let's get rid of that. Chicago and San Francisco, just because they're big economies. Each regional bank has its own members. They're actually like stockholders. The members of each regional Fed, they elect 6 directors, and three others are appointed by the Board of Governors. These are people from the region. Okay? So these 9, all 9, have to be appointed by or approved by the Board of Governors. Okay? So there are 9 directors in each regional central bank. 3 of them are bankers. 3 of them are leaders in the community. And 3 are appointed by the Board of Governors, and they're typically PhDs, right? And the reason they do this in each bank, remember, they're doing this for each of the banks, that this will give them a well-rounded overview of that region, okay? And of course, this was the compromise. This is how they got it passed through. Remember, just because JP Morgan wanted a central bank, it still had to get passed through Congress, it still had to pass the Senate, and it had to get presidential approval to even create this. So this was the compromise, that there would be multiple central banks all over the place. Each one would be like an independent central bank, and they would have their own board and all that kind of stuff. And New York and Washington, D.C. won't sort of railroad over top of the farmers or ignore what's happening in California because it was so far away in 1907. So everyone kind of got, okay, representation, if you will. Okay? The leaders and staff for each central bank gather economic statistics. So remember I said, I gave you the example that 3 of the 9 happen to be local business leaders. So they can now use all their contacts and call up all their buddies. And the Fed, the San Francisco Fed calls, their business leaders and like, hey, how are sales? How do you think, how have sales been? Are you hiring? Are you doing this? Are you doing that? Okay. So there's 2 things going on here. They get statistics on how business has been. And then they ask them surveys. Are you going to hire more people? What do you think future sales are going to be like? What? Okay. So there's backward looking and forward looking data that they gather. They take all this data and compile it in a book with a beige cover, and it's called the Beige Book. You may have heard of this thing. Okay, you can actually read the Beige Book. Okay, the Board of Governors. The Board of Governors is located in Washington, D.C. Like I said, you can go there and you won't run into tourists. Right across the street from the mall near the Vietnam Memorial. Okay, there are 7 governors appointed by the President of the United States, confirmed by the Senate. They serve 14-year terms and they rotate. So you don't just wipe out the board and add new ones, right? They rotate. The reason for this is that no president would have authority like change the board of governors and therefore use political power to force a central banking policy. Okay? Now, each governor must be from each of the districts. Okay? They tend to be economists now, not, whatever. You have to be an economist to run a central bank. Okay? And then, of course, they get together and they elect a chairperson. Okay? Like Jay Powell, for example. Okay? Being the chairperson of the Board of Governors is very important, right? They meet with the President of the United States on a regular basis. They are the ones that deliver the press conferences. They testify a couple of times a year to Congress. They can negotiate economic matters with foreign governments, and they run the FOMC. Yes, guys, that's coming up very shortly. So now, not only do they oversee the entire Fed system and meet with the president, but they also oversee the FOMC. Now, this is a policy committee, right? It meets 8 times a year. They set the monetary policy for open market operations. Okay? Also, right? All 7 members of the Board of Governors vote. I don't know why this, lost this. Better. Okay? All 7 members of the Board of Governors vote. The president of the New York Fed always votes. The reason for this is open market operations are actually conducted at the Fed, the New York Fed, because they're on Wall Street. So when they're buying and selling bonds, all the bond dealers are in New York. So the New York Fed actually does all the OMOs, but the policy is set by the FOMC. Okay? 4 of the other 12 Fed presidents vote. 7 get to discuss what's going on, but they don't actually get to do the final vote. Okay? Now, this is only for open market operations and monetary policy. The reserve requirement ratio, the RR, and the discount rate, which influences the ER, is not set by the FOMC, but that is actually done by the Board of Governors themselves. They don't need the other Fed presidents. Okay? So, yesterday was day 1 of the Fed meeting. They do it in Washington, D.C., right? Everyone gets to go, including the non-voting people. They bring staff with them. Okay? Now, the staff members, they get to attend, but they don't speak. The Board of Governors, they bring their research people. The Monetary Affairs representative shows up. And the Secretary, of course, takes the meeting minutes. Okay? So, what I mean by this is, check it out. Fed presidents, Board of Governors are all around this table. These staffers sit on the outside. They keep their mouths shut because they're peons. Okay? Now, everyone here gets to discuss things like the Beige Book, and when there's presentations like the Green Book and stuff, they can discuss, everyone gets to discuss what's going on. Okay? But not everyone gets to vote. Now, check it out. There's Ben Bernanke. Right? Who's this? J.E. Yellen. Okay. So on day 1, they approve the meeting minutes. Then the report of the manager of open market operations for foreign currency and domestic operations speaks first. The Forex person speaks first. Boom! How awesome is that? Then they ratify, then they move on. We got staff presentations. Right? This is the economic forecast or the Green Book. So did you hear in the release they said something like we think there's going to inflation is going to be steady, but economic activity will grow in 2020. Did you hear that? That's from the Green Book. Okay? Then after the Green Book's done, they go have lunch, have a couple martinis, and they come back. Then every single regional president gives an overview. This is called the Beige Book. They brought the Beige Book with them. Now they go up and they're like, let me tell you about San Francisco. Let me tell you about Chicago. Let me tell you about Minneapolis. Let me tell you about Dallas. Let me tell you about Atlanta, so on and so forth. Okay? They all give their presentations. So at the end of the day 1, everyone around the boardroom has a good idea of what's happening throughout the entire United States. Not just their little narrow region, but now they really have a good overview. They don't discuss policy. It's the state of affairs, if you will. On day 2, the Director of Monetary Affairs presents the scenario. If we do this, if we cut interest rates, this is what's likely to happen. If we don't cut interest rates, this is what's likely to happen. If we cut by 50 basis points instead of 25, this is what we think will happen. Okay? That's called the Blue Book. That is not released publicly, but someone comes in and says, here's one strategy, this is what we think would happen. Here's another one, this is what we think the consequences would be. Okay? And then, with all that in mind, now they start talking policy. What should we do? 25 basis points, 50 basis points, or nothing. Okay? So now they know what the Fed thinks will be the outcome, and then they start discussing. Okay? So at some point, Jay Powell comes in and is like, all right, we need to start formulating a statement. And they start debating on the statement and all that kind of stuff. Finally get the words, what 2 words are we going to try? Are we going to add mid-cycle? Are we not going to have mid-cycle? That little words matter, right? So they debate all of that. Okay? Then Jay Powell comes in and says, all right, I'm going to read the statement. And then it's, proposed and then voted upon and released. Now, it used to be released at 2:15. I don't know why they would change it, but it's changed now, so I'm going to update the slide. Okay? And that's pretty much it. We don't need to go into more stuff. Cool. What do you guys think? Okay? So as you can see, the dollar strength indicates that people were surprised that they said, did you hear what they said? That, what did they say, 1.65? Remember the point when I said, I'm surprised they said that. I wouldn't know how they would come up with that decision. Seems to me they would keep cutting all the way down to 0, right? Okay, you understand? So that's a little shocking for them to say, well, I think we're going to be fine around 1.65. Like, what? So it's a bit of a hint. I don't know if they meant it, and that's why this press conference is so important. I don't know if they meant to say we're almost done cutting interest rates, because we have more cuts priced in, and so by them saying it's over, it's kind of interesting. Okay? But cutting interest rates in the United States does increase the value of the dollar. Okay? I told you that when things are good, the dollar weakens. When things are bad, the dollar strengthens. The Fed cuts when things are bad.
These temporary operations were effective in relieving funding pressures, and we expect the federal funds
so the dollar gets strong.
Target range. In addition, as we've done in the past, we made a technical adjustment to the interest rate paid on required and excess reserve balances.
IOER.
20 basis points below
you know what that is?
Of the target range for the federal funds rate. In a related action, we also adjusted the rate on the overnight repurchase facility 5 basis points below the bottom of the target range. We will continue to monitor market developments and will conduct operations as necessary to foster trading in the federal funds market at rates. So
this is good. This is euro dollars coming down
earlier this year to continue to
because the dollar's gaining strength, and because euro's coming down, my euro lira is benefiting.
So that frequent operations are not required. To summarize, we are fully committed to pursuing our goals of maximum employment and stable prices. As the committee contemplates the future path of the target range for the federal funds rate, it will continue to monitor the implications of incoming information for the economic outlook, and will
so it's basically neutral with the spread and stuff. I'm hoping it stays below this 21.
The arithmetic 2% objective. Thank Thanks. I'll be happy to take your questions.
And of course, there's my entry.
Marty Krutzinger with
So
the
euro
Graphic.
weakening. Thank you. Thanks to the dollar strengthening.
In July, you characterized it as a mid-cycle adjustment. Is that still your view of what's happening?
Here comes mid-cycle comment.
As you can see from our policy statement from the SEP, we see a favorable economic outlook with continued moderate growth, a strong labor market, and inflation near our 2% objective. And
Nice.
That view is consistent with those of many other forecasters.
I think Powell's at full
As you
blast.
can see, FOMC participants generally think that these positive economic outcomes will be achieved with modest adjustments to the federal funds rate. At the last press conference, I pointed to two episodes in, I guess, 1995 and 1998 as examples of such an approach. Which
No, you'll have to go directly.
Both of those instances. As our statement also highlights, though, there are risks to this positive outlook due particularly to weak global.
By the way, leave a thumbs up, guys, if you appreciate me doing this today. I could be like doing something else. That means I've given you almost 4 hours of my life today for free. A thumbs up would be cool, man.
As we say in our statement, we will continue to monitor these developments closely and we will act as appropriate to help ensure that the expansion remains on track.
Rich Miller with Bloomberg. Taking the statement, your opening remarks, and the SEP, I'm just wondering what kind of message we should take from this. Do you still, does the FOMC, is it safe to say the FOMC still has an easing bias or not?
So the idea of having a bias is something that...
Feel free to download my chart.
We don't actually have that practice anymore.
Feel free to download my chart templates for free, guys. If you want my pivot point chart templates, my profiles, you get all these profiles, all the templates, all the indicators. For example, these indicators, okay? They're all included for free. The download link is below. Okay. Now the thumbs up, I'm saying, you know, under the video, do the thumbs up there, guys. Okay, let me pull Jay back.
So I can't really adopt it right here, but nonetheless, I'll respond to your question. So we made one decision today, and that decision was to lower the federal funds rate by a 1/4 percentage point. We believe that action is appropriate to promote our objectives, of course. We're going to be highly data dependent. As always, our decisions are going to depend on the implications of incoming information for the outlook. And I would also say, as we often do, that we're not on a preset course. So that's how we're going to look at it. We're going to be carefully looking at economic data. Sometimes the path ahead is clear, and sometimes less so. So we're going to be looking carefully, meeting by meeting, at the full range of information, and we're going to
looking at Aussie dollar
stance of policy as we go. And as I said, we will act as appropriate to sustain expansion.
Check this out.
To just follow up, you've also said that the favorable outlook is predicated on financial conditions, and the financial conditions are in turn predicated on an outlook for Fed policy. In this case, further cuts. Wouldn't that suggest that?
Okay. I'm looking at next week's entry. I might be buying this at 68.
To come about, you should be inclined to cut.
I might be buying this at 68. So we'll see.
Going forward is very much going to depend, Rich, on the flow of data and information. We've seen, if you look at the things we're monitoring, particularly global growth and trade developments, global growth has continued to weaken. I think it's weakened since
beautiful trade this month. Perfect trade plan.
Down and then up, I guess. We're back up perhaps over the course of this intermediate period. In any case, they've been quite volatile. So we do see those risks as actually more.
Funny thing is, if I buy it near 68, I'm going for 70.
And we'll have to make an assessment.
It's not a lot of money. It's not a lot of pips. Here we go. Whoop, 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 whoop.
Thank you, Mr.
Look at that, man. Look at that.
Journal. I know you're trying to speak for the committee when you do these press conferences, but the committee is clearly divided right now, at least about the outlook and the appropriate policy path. Some people think you need to
Who's
wait
this guy?
and see the labor market and the consumer crack or weaken further before acting more aggressively. And some people think that by the time that happens, you'll need to do even more aggressive action to arrest a downturn. Where do you stand on this?
Well, let me just say, on the general point of diverse perspectives, you're right. Sometimes,
Okay, let's look.
and there have been many of those times in my now almost 8 years at the Fed.
What do you got?
Many times when the direction is relatively.
So you wouldn't want to do it here, really. I mean, I guess this would be your best shot, right?
And as you can see, just
it's pretty good.
And as I really do think that's nothing but healthy. And
yeah, if you're taking this north, sure.
So your question though is
your own view, because the data is to some
you
extent,
don't have to worry about oil or anything like on
have
this
these
one.
risks on the horizon, and the markets obviously think that these risks could materialize more than what.
So you half as much on Noki, plus you got oil risk.
Where are your own views about the tension between risk management?
Okay. So you can see DKK is just as good as SEC. Or SEK, I mean. So you might also use Denmark long.
That the idea that
as well as Sweden long.
Approaching on the horizon, you steer away from it if you can. I think that's a good idea in principle. I think history.
Anything for you, Rod?
It's better to be proactive in adjusting policy if you can. I think applying.
Well, Jared, of course, gold dropped hard. Dollar went up.
Is where the challenge comes.
Okay,
so,
dollar went up, and gold would go down.
The committee, the bulk of the committee is going meeting by meeting, and I
take
think
care,
the
Adam.
takeaway is that this is a committee that has shifted its policy stance repeatedly, consistently through the course of the year.
Okay, I'm going crazy.
Activity as it is felt that it's
look at DKK as well as SEK.
We were looking at further rate increases, then we were patient, and then we cut once, then we cut again. And
guys, for people just logging in and stuff, I'd be like, if you're asking me to look at gold because you don't have a trade plan on gold, then I'm shocked because you know what you're doing won't work. You either had this planned out a day ago, a week ago, a month ago.
CNBC. I've only done this a couple of times.
Hang on.
I wonder if you're concerned about how the Federal Reserve
Steve Leisman
through the recent liquidity crunch in markets.
So he's talking about the repo rate yesterday and today.
The tax date payment was known well in advance. There were several reports of people pointing to September as a potential crunch time. You closed Monday at the top end of the Fed funds rate. Tuesday came along and there wasn't an operation until 9 o'clock and no announcement until of a second operation till 4 o'clock in the afternoon. Was the Fed listening to markets well ahead of time, going back a year when there were blowouts in the overnight rate at year end and the turn of the year? Are you concerned about how?
So what he's trying to say is, do you know what's going on, Fed?
I doubt that anyone is closer to and has more invested in carefully following the behavior of these markets. So of course we were well aware of the.
So that repo market froze yesterday, guys. The Fed injected $75 billion yesterday in liquidity and $75 billion today. And Steve Leisman of CNBC said, "Are you guys morons? Like, how come this even happened, Fed? If you're in charge, how come you didn't know there was going to be a liquidity problem?"
Then certainly than we expected. So no, I'm not concerned about that. To answer your question, I can go on a little bit about how we're looking at that. Why don't I do that? So, as I mentioned, we don't see this as having any implications for the broader economy or for the economic outlook, nor for our ability to control rates. The strains in the money markets reflect forces that.
Okay, again, Jack.
Had a bigger effect than I think most.
Okay, I'm going to pause him. Don't use language like that. Don't say things like, "Where do you think gold is going?" You either know technical analysis or you don't. So technical analysis tells you where gold is going. So I don't have an opinion. Okay? So don't put it that way. Don't say think. Okay. If I'm a bear, it's extremely clear we're going to 1383. You would only think that, though, if you were a bear. Okay? But I look at the chart like, that's it. There it is. That's not my opinion. I muted it, Jonathan. Okay? So don't say things like think, because when you ask me, where do I think gold is going? It's like, what you're saying is like, what's your guess? I don't have a guess. I use technical analysis. It gives me the exact price. Okay? So, yeah. So it's on our way to 1400. Okay? If you're a bear, that's the answer. Okay? If you're a bull, well, this gets complicated. We got this month's M2 coming up, and we also have next month's M2. So I would look for bounces at 1460, and then a follow-on bounce at 1480. Okay, so if I'm a bull, I'm going to look for something like this now. Okay, if you're a bear, you're looking at, well, first of all, you know this is a sell, right? So now you're doing stuff like this. Okay. So I'm not harping on you. I'm not picking on you. I'm just saying don't use language like that. Okay? There's nothing about think. You know or you don't trade.
Anticipated strong demand for cash to purchase treasuries and pay corporate taxes. We took appropriate actions.
So that's as loud as he
to address
goes.
those pressures to keep the Fed funds rate within the target range, and those measures.
I can try a different. I can go Yahoo Finance to see if that's better.
Would seem to suggest a sort of a more aggressively dovish path than the one that you chose.
No, that's as loud as it goes.
I think to provide a little context, Fed economists do research all the time. It's generally a very high quality. It's their research. It's not an official finding of the Federal Reserve Board or the Federal Reserve System. It's just
everything is max, guys.
They put it out for public review that you can see their econometrics.
Yeah, Jonathan, I've provided the link, and other people have provided the link more than once. So what I'm trying to tell you is open it up on your own computer.
You know, what this particular piece of work did is it went out.
Okay. But anyways, I'm going to skip. I think we're done. Let me know if this was helpful. Let me know if you want me to cover another FOMC meeting. Leave a comment under the recording. Download all my chart templates for free, guys. If you need to learn how to trade, would you please consider taking a video training course at FXBootcamp.com? I can teach you fundamental analysis, technical analysis, swing trading, monetary policy, day trading, all this kind of stuff. That's FXBootcamp.com, okay? Skykiller says, my point of view, does the Fed do a good job? Well, which Fed? So generally speaking, my answer is yes. I know we would not have gotten out of the global financial crisis without the Fed. I think Ben Bernanke did an amazing job. Jay Powell, I think, is doing mediocre. But then again, he's not an economist. So I never expected more than this, but raising interest rates and then cutting interest rates doesn't make a lot of sense. Okay? So I'm always dubious of a central bank. So I'll give you an example. Jean-Claude Trichet, at the beginning of the financial crisis, raised interest rates. At the very beginning of the financial crisis, and the markets were crashing, the European Central Bank raised interest rates. And then something like 10 days later, wasn't even at a meeting, they started slashing. So somewhere in a period of 10 to 14 days, they went from raising interest rates to slashing interest rates between meetings. So I'm like, well, what did they learn in 10 days that they didn't know? I don't understand things like that. Okay, so cool. And is anyone interested in joining the swing trading group? We meet tomorrow at 11 a.m. to set up trades 3, 4, 5 days in advance, looking for about 300 pips per trade. I'm going crazy. I didn't say I would buy Aussie. I said I would look to buy Aussie. One is just really a follow-on. I wouldn't do it against dollar, though. I'd probably do a follow-on on Aussie yen or Aussie Swissy, okay? But if Aussie stabilizes on the support, so the first thing I noticed on Aussie dollar was it was at support. So if Aussie dollar stabilizes, then I might start tiptoeing into Aussie yen and Aussie Swiss franc trades. Okay? Right on, guys. Well, I used to have a closed group. Used to have to spend a couple of $1,000 just to get into the group, because I forced you to take trading courses and stuff first, and then, right? So now it's much cheaper and much easier to join. You get the training course included. So if you want to join the swing trading group, it's never been more affordable. It's never been easier. So visit swing.fxbootcamp.com. Like I said, we meet once a week. We set up trades that are 100 to 300 pips each. And you see these trades 1, 2, or 3 days in advance. Okay? Yeah, these charts are working. They're on 4 hours. Okay? There you go. So you can see, since I said, hey, Aussie looks interesting, Aussie's gone up. Okay? Okay? Email me, Sophie. Oh, well, I'm going to release a new version very soon, I hope. So, anyways. But they're just chart templates, so there's, I don't know what, maybe you're installing MT4 into MT5 or something. Okay. So anyways, peace on earth, may the pips be with you, may our profits be above average. If you subscribe to the YouTube channel, then I will meet with you tomorrow morning at 8 a.m. New York time, and we'll set up the Thursday trading day. And then, of course, the swing trading group meets tomorrow at 11. So take care.